As always, we try to source solutions for you and your personal finance issues. And this time, many of us have heard about the theme of tax-free savings accounts. But the concern is, how do you invest in them, and what kind of return can you expect given the underlying asset that your money is actually pumped into? Now, we did hear of an increase that took place beginning of this year, the financial year, which was the 1st of March 2017, that there was an increase of the tax limit being 30,000 Rand to 33,000 Rand. And that's the level of the contribution that you can make to tax-free savings accounts. To tell us more about this and how to make sure that you're actually getting the most bang for your buck is Ricardo Teixeira, Certified Financial Planner and Chief Operating Officer at BDO Wealth Advisors. Good to have you with us, Ricardo, and thanks for making time. Let's unpack tax-free savings accounts for a moment. Just exactly what kind of investment options can one put their money into? Sometimes you get exposure through banks as well as investment houses.
Right, yeah. I think that's a good place to start, Gogo. And I think the misconception has been one that tax-free savings are limited to cash savings or money market savings. The reality is that, as you've alluded to, they actually are open to a wide range of asset classes. And that could be equities, bonds, cash, and listed property. Essentially, any listed asset could be blended and held within a tax-free saving account.
So the trick is actually to identify these products efficiently and ensure that you understand what the underlying asset is.
Correct, that's right. So the vehicle is one thing, and that's governed by legislation, but it's actually applying what is the right mix of assets to your personal circumstances and the return that would make best to you, that one should actually spend a bit of time doing a bit of homework before you commit to the tax-free saving.
Is there a catch to this? People tend to hear limits as well as some penalties, and we tend to get quite scared about this. Are there any catches to this, Ricardo?
Yeah, that's an interesting point you raise, because I think if we look at the stats, tax-free savings accounts were launched in the 2016 tax year, and there was quite a slow take-up, and what we see now is the level of education, and we just benchmark it against our clients at BDO. We've noticed an increased awareness of the benefits and the opportunity of using a tax-free saving. And I think one really needs to then just understand that the limits are not scary and the limits are not a negative. They actually are there just to govern it. So essentially, there's a cap on your lifetime. So you can cap yourself out at R500,000 Rand in terms of capital that you've invested. And you're really restricted to put in a maximum of 33,000 Rand every tax year. But not scary limits, Gogo, and not a limiting factor in any way.
And I guess with the increase from 30,000 to 33,000, that comes as a benefit, because now you can throw in an extra 3,000.
Correct. And I think the benefit you point to as well is the one of compounding.
Yes.
And that's really the benefit of tax-free savings, is the longer the time frame that you've actually had the money in the markets, the better your return, because they're growing without any tax deduction. So your returns are totally tax-free, as the name of the vehicle implies.
But should you over-invest in this particular vehicle, there are penalties and you will be taxed, right? And there's a brief example that you can give us here.
Correct, that's quite right, yeah. So the purpose really for legislatures was not to actually allow for this to be an open market for everyone just to put all their assets into one vehicle. So it was specifically limited, and the limit is the 33,000 Rand currently that you've mentioned. And any amount that you contribute in excess of that, there are very staunch and very severe penalties, as high as 40% of the amount that's invested in excess of that limit could be taxed within your tax return for that year. So the advice is really just keep to the limit. Don't put more than 33,000 Rand a year into this specific vehicle. Anything in addition to that, speak to your financial planner, and he or she will advise you on alternative vehicles for saving.
With the investments, though, Ricardo, it goes back to the investment objective and how it appeals to the respective client. Talk us through how parents can use tax-free savings accounts for their children, how they can use it for themselves, enhancing their retirement savings. And what about pensioners? How do they fit in taking advantage of this particular asset?
Okay, so I think the reality is, and you're quite right, is the starting point always has to be understanding the individual that's utilising this vehicle and what their long-term objectives are. Purely I say long-term because you really only benefit over a period of time in terms of the tax-free compound returns. So if you look at the individuals you mentioned now, to start with a child, it's an ideal opportunity from just a compound perspective, starting to save for a child right now in terms of putting away the 33,000 rand a year. The child may not be a taxpayer, but by the time the child is a taxpayer, they've really got the advantage of time in the sense of having the returns compounded over those years prior to them being a taxpayer, if that makes sense. But then if you look at as an adult who is currently saving towards retirement, I think you must be careful not to jump to using a tax-free saving vehicle solely or before you've utilised your retirement saving dispensation and allowances. And the reason why I say that, Gugu, is that the objective of actually getting a tax deduction, or sorry, the opportunity of getting a tax deduction only really applies to retirement savings and not to tax-free savings. So any contribution made to a tax-free saving is really after-tax money, whereas a contribution made to a retirement saving vehicle, you do get a deduction from your current taxes, as well as the fact that that retirement saving vehicle would grow tax-free. So as an adult saving for retirement, I think one needs to take advice and look at what's best for your scenario. The situation of a retiree, or let's say an older person who's already in retirement, they would most certainly benefit from having a tax-free saving, purely on the fact that any excess income that is currently being taxed in a cash account or any collective investment scheme and earning dividends could be shielded through this tax-free savings vehicle, and at the same time knowing that the vehicle's liquid, and during their lifetime they can obviously make the contributions but still make the withdrawals.
Exactly. Ricardo, we'll leave it there for today. Thank you so much for providing perspective on these, something that all South Africans need to make use of, tax-free savings accounts. Ricardo Teixeira, Certified Financial Planner and Chief Operating Officer at BDO Wealth Advisors.